Very, very welcome, everybody. It's time for the Thursday night stock and option webinar. See how everything's going, how everything's playing out, what we've been up to, what we got going on here. Pretty excited to talk about some of this stuff here. So I'm glad to have you guys with us. So welcome. Is that Brian, Brian, Orange County, Brian? Anyway, good to see you, my friend. If it is, if it isn't, still happy to have you. Carolyn, good to see you. Let's talk a little bit about what's going on in this stock market. Is anybody, how do you guys feel about what you see going on in the stock market right now? Is everybody just like, hey, this is business as usual, or what's up? Where are things going? I saw one headline a couple of days ago that one of the big deal investors said, the stock market and the economy are completely divorced, right? And I said, well, maybe not divorced, but they're sleeping in different rooms, that's for sure. So that being the case, you know, what is our goal? What is our goal here? What is our goal? Rondell, yes. Uncertainty is a safe word to be using in these market conditions, that's for sure. Mary, pretty surprised it's still holding up. Now, and Mary, I'm glad you bring that up because one of the most important things that we can do is just trade what we see. I tell people all day, every day, stop trying to outthink the market because it's not going to happen. You'll be wrong 104% of the time, right? We can't outthink the market. All we can do is have a strategy, trade what we see, and go for it. Whether you're really bearish because you have an opinion or really bullish because you have an opinion, remember, the market doesn't care. It doesn't care 0.1%. It only cares about what it's going to do. And all we can do is just follow it along. And this is a very important discussion to be having right now because I think everybody is pretty surprised at what's happening, right? We're pretty surprised at the fact that employment numbers were just announced, right? Again, every Thursday we get these employment numbers, and it's really strange, actually. Most Thursdays, I need to look at a calendar here, but many of these Thursdays, what was last Thursday? So today's the 14th, obviously it was the 7th and the 30th. If we look at those days, I'm just curious because we had this nice big run up on the SPY today with these terrible unemployment numbers. And we have this, so what did we have on the 7th? The 7th was somewhat of a positive day. It wasn't really a negative day. The 30th, the 30th came down a little bit. You know, so we have these, let's see, would have been somewhere maybe 23rd. These horrific unemployment numbers, and they're nothing short of horrific. The market seems to shrug that stuff off like no problem, right? Today was weekly jobless claims, basically another 3 million, just shy of 3 million, which was actually worse than expected. Most economists were looking for somewhere in the mid 2s, 2.5 million, somewhere in that general vicinity there. And so we get 3 million. So we get obviously a terrible number anyway, and then it's worse than the terrible number that everybody was expecting. And the market goes up, right? It goes up and up and up. So it's quite a situation. The 8-week total of unemployment claims, people going to get unemployment benefits, 36 million in the United States of America. That's pretty high. That's pretty high. So 36 million is not a good number. But the market apparently continues to go right on up. Let me type Dory a message here real quick. Actually, I'm going to type this to all because some people audio found in the there we go. So these are kind of strange things, right? We have these terrible unemployment numbers. The market seems to be pretty solid and pushing higher. And it's just kind of got everybody kind of scratching their head a little bit. And that's why I go back I go back to this whole don't try to outthink the market, because outthinking the market right now would say we should be bearish everything. And yet the market continues, in general, the stock market has been going higher, except for obviously some of these airline stocks and so on, which are making little dips here. But we just got to trade what we see here. Now, if we look at, in the past weeks, we've talked a little bit about the patterns and kind of looking for those types of things. We have this rising wedge that we've been just watching kind of week after week on the SPY here, that's telling us, this rising wedge is telling us that we should see some breakouts, right? We should see some bearish movements. And we tried to see those bearish movements, right? We had this big run down here, and then we have this movement right here, right? This narrowing rising channel. And it breaks out, and it pulls back up, right? And then it's dipping back down, and it's starting to look a little bit more like this is trying to kind of obey the basics of just charts, right? Which the basics of charts are, follow the patterns, get a rising wedge. We should get some bearish movement. We even got a little double top in here, but this is actually kind of just created a little bit more of a channel. We're kind of starting to see a bit more of this sideways channeling happening here. And this is starting to get a little bit more of my attention. I'm saying, oh, okay, is that what we're going to see happen before we start to get a much bigger, more aggressive movement like that, or bigger, more aggressive movement like that? I think this channel is going to be very telling about where things go from here and kind of how they play out. Sorry, Norval, I missed your question. What is the other EMA on your chart? 220? No, Norval, on my chart, I have the 200 and the 50. So the 200 and the 50. The red one is the 200. That little black skinny one is the 50 moving average. Those are the best, the bestest, mostly the best. So the question is, how can we trade this? What are some things that we can do with this kind of market? I'm kind of, as far as trading the indexes here, we have a little bit of a challenge. We have a little bit of a situation. The S&P basically is made up of a bunch of great stocks, but really 5 of them are what get it moving, right? And so in this kind of situation here, excuse me, what we have is a scenario where a couple of companies are kind of keeping the S&P up, and a couple of companies might be enough, but if they start to pull back, right? If they start to take we start to see some profit taking happening, people are starting to get out, then the S&P has the potential of making quite a big move down, right? If some of these other big companies that are holding things in place slump a little bit, which is possible, then we maybe run down to double bottom territory, right? But if things continue to hold, then maybe we don't. Maybe we just continue to see this channeling and this consolidation. And how does a rising wedge fail? A rising wedge fails when we get this kind of movement, right? We get that big run down, this consolidation up, and then we just start to get this sideways consolidation. And what ends up happening is in that sideways consolidation, this is able to kind of build up enough pressure to just continue breaking out and running to the upside. And that's how this could fail. So I don't think I'm super bearish SPY until we start getting below about 280. I think this is going to be a big area to be watching, right? 280-ish, somewhere in there, because that's kind of the bottom of this channel, this little short-term channel that's been in play since about mid to early April, right? So that's kind of been holding the phone there. We did get that little dip below 280 down into the low 270s, 272, 273, and then it pops back up again, unable to close the day below that level. In fact, closing the day in a pretty bullish pattern here. So if I'm looking at the SPY, and again, for anybody that's saying, okay, SPY is the first time I'm seeing this, what is this? This is just an ETF that tracks the S&P, right? S&P 500 here in the U.S., big stock exchange that that, or excuse me, big index that you know is comprised of 500 of some of the biggest most profitable companies in the U.S. Right? So this is just tracking that movement. But as we're talking about here, we've got a lot of companies in the S&P that aren't doing well, and a lot of companies in the S&P, or a few companies in the S&P that are doing well, that seem to be kind of carrying this forward. So again, we're not going to trade what we think here. We're going to trade what we see, and what we see is a channel. And if we get below this channel, we get below this 280, I think there's going to be a decent opportunity for some bearish movement. Likewise, if this starts breaking above that 295, I don't think that 300 is going to be a big stopping point. It could be, but I'm looking at this channel as being what the channel is right now. And the channel is kind of, 294, 295 at the top. If we break through that, I just can't see 300 being a big stopping point, and I'll just put on a bullish trade and go for it. Okay. Before I carry on and talk, do you guys, how do you guys feel about that? Is everybody clear on how that's playing out, how that should work? Does anybody have any thoughts? Anybody want to put anything in there and have any input there? Mary, when I talk about 5 main companies which influence SP, which ones are these, and which do you think are the ones typically holding it up? We've got some big companies like Amazon, right? Amazon trading in the S&P. That's a big one. That's probably holding the S&P up itself, right? And it's always kind of a chunk of stocks, right? Now, in the case of the Nasdaq, it's a little bit different, right? So many of the tech companies are doing really well, and they're really just kind of running up, and that's why we see the Nasdaq. Whoops. That's why we see the Nasdaq doing quite fantastically well, because most tech stocks are just running straight higher. They're just going straight up, and so that's why we have this just pure V bottom reversal, right? This thing just dropped down and moved its way right back up again. So tech stocks are pretty uniformly doing fairly well. We are getting kind of a little bit of a descending trend line working its way in here, but we're going to be able to break through that probably fairly easily. We'll see. We'll just trade that confirmation. But yeah, S&P, I mean, if you look at all the companies in the S&P, it is very much not a uniform picture, right? We don't see all the stocks recovering in the S&P like the S&P itself is recovering. Ray, what would you say the chances are that SPY will stay in that channel moving forward? Well, it won't stay in the channel indefinitely, right? The SPY will stay in this channel for a period of time. No stock, no chart, no currency, no anything will stay in a small channel for very long, right? Now, it doesn't mean that when it does break out that the movement's going to be real aggressive. But the longer it stays in this channel, the more aggressive that breakout will eventually be, right? So, for example, if tomorrow rolls around and this kind of goes, oh, okay, and starts running back down, I would expect, most likely maybe a slow, steady movement down. If, on the other hand, we see that the SPY ends up doing this for, and respects those channel highs and lows for maybe another couple of weeks, then that's going to be probably a much more aggressive breakout. And then at the breakout there, I would expect a much more aggressive movement. But yeah, it's you never can tell how long something's going to stay in a channel. But typically, the longer it stays in a channel, the more the more energy is kind of pent up in that market, and the bigger the breakouts tend to be. But you can never really tell how long they stay in there. That's a good question. Lenny, it'll stay until I put on a trade that assumes the channel. Exactly. It'll stay in long enough until somebody tries to jump the gun, and then that's when it breaks out in the opposite way. So yes, absolutely. That's funny stuff. So so when we see that kind of thing happening, we look at this and we can say, well, if the SPY is the thing to trade, you know, what kind of option play can I have here, right? How can I play this? How can I work this? You know, where's my opportunity on this? You know, the way that I've been trading this market mostly is through credit spreads, right? I'm really a big fan of credit spreads, and I'm a big fan of especially newer option traders using credit spreads as well. It's a low risk strategy. It pays less money. I don't want to be the guy that's playing not to lose instead of the guy that's playing to win. But at the same time, these credit spreads, there's plenty of money to be made on them, and the risk is so much better in our favor. So what I'm going to be doing is I'm looking for that break, right? I'm looking for that break out of this channel. I want to see this thing break out. I want to see this break below 280. I want to see this break above 295. I want to see these breakouts happen. And once those do happen, you know, yes, there could be a much more profitable, higher risk trade to take here by just buying a naked option, maybe buying a call or buying a put, depending on which direction it breaks out. If we see that breakout up, we buy a call option. Great. And if it makes a nice big move, we make a bunch of money. If we see a big breakout to the downside, we buy a put, make a bunch of money. Everybody's happy. But if we get kind of a slow, steady run and the direction's just not what we're hoping for, and it's not moving as aggressively as we thought it might, which is what the market loves to do, right? It loves to set up a nice, big, great, wonderful trade and then not really do anything super, you know, super extravagant with that trade, you know, with that move. And so that's where credit spreads can come into play. And that's, you know, just to kind of show everybody, I know some people are very familiar with credit spreads, and I know some people are very not familiar with credit spreads. And so I want to just kind of show you guys what that can look like here. This is my broker platform. This is Tastyworks. They're real good folks, and I love them. I love them so much. And in fact, Tastyworks has ruined me to every other stock and option broker on the planet. They all have terrible platforms once you get used to this one. It's so easy to use. So if I want to put a credit spread trade on, let's say that we see SPY get back down below 280, right? Let's say we see this back down at, you know, 279. I'd like to see a daily close. And this is going to be a tricky play, right? I want to see this close below 280. I want to see it close the day below 280, because so far we've had some dips, right? And those dips are quickly reversed. So let's get some daily candles closing above or below. I don't care so much about the middle couple of points that it's moving up and down. I want to see those, you know, those big closes below or big closes above. But let's say this thing closes below 280, 279, right in that general area there. If it closes below, then I would probably do something like this. Let's say that happened today, right? Or it's happening as we speak, you know, kind of a thing. I would probably do something like this. I'd probably be looking for a 279. I sell a 279 call, buy a 279 call. Now, these are not going to be very accurate numbers because that's not where the current price is. But assuming the current price is right around that area, that's probably around the numbers that I would take. Now, to give you a little bit better of a sense of kind of how that pricing would work, I'd probably sell about one strike price lower than where the stock, or the SPY in this case, is currently trading. I'd sell one below, and I'd probably buy the at-the-money call option. So I'm going to sell that, you know, that one strike below the current stock price, and I'm going to buy that strike that's at the current stock price. Now, these are only $1 apart, 284, 285, you know, 282, 279, 280, that kind of thing. But you can see the pricing's pretty good on some of this stuff. If I'm going to get 63 cents per option, that's $63 per contract, and that's about $37 of risk, right? So if I go over here, it's going to tell me my worst case scenario is I'm going to lose $37 per contract. My best case scenario is I'm going to make $63 per contract. This is going out about 15 days, right? This is 15-day expiration. If I go out a little bit further, might give me a little bit more, maybe not 18 days, actually gives me a little less. If I go out 20 days, apparently it's giving me nothing. Gives me about the same, right? We go out here again. gives about the same. So we're not getting too much benefit by going out further on this expiration. Typically, if we go out a bit further, we can improve that. But here's one thing I want to just kind of remind everybody of. When you're trading a credit spread and your strike prices are $1 apart, anytime you get anything better than kind of the 70 cents, anytime you get better than 70 cents, meaning you're getting $70 per contract and you're only risking 30, that's great. But we kind of get into a little bit higher chance of getting assigned the stock. Now, if you have a big enough account that you can afford for these options to be assigned to a stock position, I love assignments. I go to bed dreaming about assignments at night, right? If the broker assigns my option trade, I love it because I can make so much money on assignments. I can make way more money on an assignment than I can trading, just the option play. And so I'm always happy to get assigned. But if you don't want to get assigned on a stock, then you want to make sure that you're not getting too much money to get into the trade. And anything over 70 cents with $1 distance between those two strikes, you're really pushing the assignment scenario, because that means that you're really getting far into the money on a credit spread. Now, if anybody is feeling unclear about what this is, here's the current stock price. If I'm getting assigned on this and I'm expecting, maybe a big move down, now that stock price is what we would call in the money to these call options, right? And so I go down here a little bit, maybe I go down here a little bit more, and see how I'm getting a little bit more money for that trade. I'm getting paid $72 per contract, and now I'm only risking $28 for that trade. I'm now getting into heavy, territory that the broker is going to say, hey, partway through this trade, especially if this thing goes the other way, because we're thinking, hey, I'm only risking $28. That's awesome. Or if you go up to, a couple of contracts, maybe say I'm trading 10 contracts and I can make $720 on that trade. I'm only risking $280. Totally awesome. Totally good if this goes our direction, right? If you put this out 5 or 6 strikes away from the current stock price, and you're getting $72, $75, $78 per contract and only risking in the 20s and so on, then our chance of assignment just gets higher and higher. And partway through that trade, especially if this goes the other direction, the broker might say, so sorry, your trade is now, you now own, 1,000 shares of SPY, right? Now, it's not a bad thing, because you can say, well, obviously, I have a $10,000 account, $20,000 account. I can't afford to have 1,000 shares of SPY. And, with my broker here, Tastyworks, they'll say, well, that's no problem. You can keep your risk at $280. You just got to, there's a few more fees, another $5 or $10, and you got to close that trade out in a loss. Now, if the trade goes your favor, because our whole goal right here is to get the SPY below our sell to open call option right there. So if this were actually trading at 285 and we actually did put a trade on at 279 and 280, we want the SPY to get below 279. And if it did, we make $720 with a $280 risk. Problem is, this goes the other way, and now this is up in the high 280s, low 290s. The broker is going to tell us, sorry, that's not going to work. So if we go a little closer to the current price and we're getting a little less money, we're risking a little tiny bit more. Instead of 280 and 720, we're getting 630 and risking 370. Not as good, still pretty good. We're still kind of nearing that 2-to-1, but we're taking a little tiny bit more risk and we're making a little tiny bit less money. But in a scenario like this, it's very unlikely that we'll get assigned the position, meaning they're going to convert one of our option legs to shares of stock. Just putting that out there. Want to make sure everybody's clear on that. Does that make sense? Is that answering questions that some of you may have had and now are kind of saying, oh, okay, I gotcha. That's why that stuff happens. The other thing is, obviously we had a lot of really volatile market conditions in March and April. And the more volatility there is, the more brokers say, we're not gonna, most of us are trading on margin accounts, right? And so the broker is saying, look, at some point, the broker's on the line as well, and they're taking some risk, and they're going to say, hey, this is too risky of a situation. We're going to assign you and take a little risk off of us for having to come up with all that money. Because the broker, keep in mind, in a margin account, if you get assigned, they'll say, okay, your account is now $100,000 in the negative, and you either have a day to give us $100,000, or we have to close your position. And you could say, well, things can happen, right, that give brokers extra risk there. And so they're not going to take endless amounts of risk for, Jared Johnson, the trader, because that causes problems for them. Okay, so that's a lot of talk about assignments. Some of you guys might be thinking, what in the world is all of this stuff? Or why do I care about it? Or yes, I know what an assignment is. But that is just a little bit to think about. Just a little bit to think about. Okay, so that being the case, what I want to do and how I want to trade some of these movements is just pretty simple, pretty straightforward, right? I'm going to trade a credit spread. Some of you have, I know some people have had a little bit of trouble understanding what credit spreads are and how they work. Take all the time you need, ask all the questions you need, but a credit spread is a pretty simple situation. All I'm doing is I'm selling a call option at a price that I believe the stock can stay below. And I'm buying a call option above that price to protect me. So it just protects me, right? I stop losing money at 285 because this is kind of my hedge. This is my insurance policy, right? As long as this stays below my sell to open call option, and this is where people get a little confused with credit spreads as well. They say, okay, this is a bullish trade, right? No, wrong. Because when we sell the lower call option and we buy the higher price call option, the whole goal is that the stock gets below that sell to open price because we're an option seller. You might say, well, how do I know if I'm an option seller? Because I'm selling and buying. If we buy the higher price option, the higher strike price, and we sell the lower strike price, then we are option sellers. Now, if you switch it like this, so that now it's the exact same looking thing, but now we're selling the higher price and buying the lower price, that's actually called a debit spread or a long call vertical. This right here is a short call vertical. We want the stock to stay below 284. Right here, we'd want the stock to actually go up, right? So it's all about that order in which you buy to open and sell to open. Okay, Norval, yes, this is a bear call spread or a short call vertical or a credit spread. Yep, all those names. Yep, Dan, exactly. So these kinds of trades, remember, these kinds of trades are so they're so safe and they're easy money to make. I always tell everybody that a credit spread versus buying shares of stock. Now remember, let me just kind of back it up a little bit to kind of bring a few things together for everybody. Remember, if you can do these trades with stock and take a little bit less risk and potentially make a pretty good amount of money, but it's going to tie up a ton of money, right? To do this kind of a trade with 1,000 shares of SPY is going to cost me an incredible amount more than this $380, right? This is my margin, $380. If I say, okay, I'm going to do this trade, they're going to say your buying power plus a couple of fees is going to be reduced by about $400. If I were to do this trade in just shares alone, yes, I could make a lot of money and I could take less risk, but I'm going to be tying up tens of thousands of dollars doing this trade, right? Like hundreds of thousands of dollars doing this trade. I forget, these guys are trading the 200 plus. So there's that side of things. There's the element also of if I think that there's a big aggressive bearish movement, right? This is a safe, low risk bearish trade. This is me saying, hey, I think the SPY can stay below 284. And if I'm wrong, I'm risking $380. If I'm right, I'm making $620. Awesome, almost 2 to 1. That's totally great. If I wanted to go with the aggressive bearish trade, I could say, well, I'm actually just going to buy a put. Now, if I'm buying a put, then I just want the market to go down, right? I want this thing to head straight south for me. But now look at my numbers, right? Maximum profit, if the SPY goes to 0, I can make $27,640. Awesome, great. If it goes against me, I'm on the hook for $760. So my worst case scenario here is $760. Yes, my best case scenario is pretty great, $27,000, but what are the chances that the S&P is going to 0? Pretty much the same, 0, right? So now I'm going to say, well, I'm taking about double the risk, and I could make more, and I could also make less, right? I know I've gone over this with many of you guys before, but it's something that I think bears repeating. The difference from buying an option versus selling an option, right? If I'm an option buyer, I have limited risk, which is great. So if I buy an option for $100, I can't lose more than $100. I have unlimited profit potential. That's important. But time is working against me, right? Because options, when you buy a naked option, the value of that option is going down the closer we get to expiration. There's a lot more demand for an option that has 3 months of expiration because that's more time that option can run and it's more money that option can make. There's a lot more demand for that 3-month option than for that 3-day option. Option that expires in 3 days, nobody wants it. It's kind of like food at the store that expires tomorrow versus stuff that expires in 2 weeks, right? So time's working against me. The value of my option is losing against time. And don't forget, the market needs to move big time, right? So if I'm going to buy that put option or I'm going to buy that call option, if it ends up breaking out and going like this, and I bought that put, then I'm just approaching that expiration and my option's losing value. Even though the trade's not going against me, I'm losing value because it's not getting offset by the stock going the direction that the put needs it to go to gain value. And that would be the stock going down, right? So when I look at it like that, then I say, well, you know, maybe I should trade a credit spread and maybe I should be on the option seller side of things. I know that this is some elementary information for some, but I want to make sure that you guys understand how this all works because it's pretty darn important. So if I'm an option buyer, there's my scenario. If I'm an option seller, which is a credit spread, as we mentioned over here, this is me being an option buyer, this is me saying I'm buying a put expecting this to go down. If I'm an option seller, and that's a bearish trade, right? If I'm an option seller, I'm saying, well, I'm actually selling a call and just saying all this has to do is stay below 284. I don't care if it's at 283.99 or if this thing drops like a rock. I don't care. Just stay below 284. That's all you need to do. And if that happens, yeah, I mean, I make $62 per contract. I risk $38 per contract. Or I make $620 trading 10 contracts. I risk $380. But what are the big differences over here? Option seller, limited risk and limited profit potential, right? Oh my goodness. So, and those things are not, you know, limited risk, that's great, but it's not very appealing to say, well, you also can't make as much. Who wants to do that? But remember, guys, there's a couple of important things that happen in trading. Number one, picking directions is hard. Being right about bullish or bearish, because remember, we all have our thoughts, we have our egos, we have all kinds of stuff, right? Where we say, I think the market should be doing this. It's not doing it, and I'm losing money, but I think it should be doing it. Trading direction is tough. And with options selling, all we're saying is, hey, stock, can you stay above this level? Can you stay below this level? Just stay where you are. Move around a little bit, but stay where you are. When we're trading naked calls or naked puts, we're saying, hey, stock, you have to do a couple of things for me. You got to move big. You got to move fast. I have to be getting in the right time so that it's not going to consolidate for another month while I'm sitting in it and go nowhere. And it needs to move big for me, and I need to be right about the direction. See how difficult all that stuff is when you're trading a naked option? So if I'm selling options, yeah, I'm going to make a little bit less money, but you know, out of 10 trades, I might be able to win 8 of these, whereas 10 trades being an option seller, I might lose 8 of those, right? Because the market needs to move big, it needs to move quick, I need to be getting in at the right time, all this stuff that's just tough. So the good things as well about being an option seller is time is working for us, right? So if you're selling an option and that option's losing value, remember, you're paid to get in to an option sell position. So if you're selling a credit spread or any of that stuff, you're paid to get in and you have to buy your way out. So the more that option loses value, the less your buyout is. And then you get you know, if you're paid $100 to get in and you can buy out for $20 because that's losing value and it's going the right direction, all that stuff, great, you get to keep $80. So time is working for us. That's a good thing. That's literally being an option buyer versus an option seller is like owing money to a credit card company, paying crazy interest versus loaning money to somebody and they're paying you interest, right? That's the difference of time working against you and time working for you. So as an option seller, time is working for us. Number 4, market does not need to move big, right? So now this stuff right here where I'm saying, okay, this is the risky, this is the big guy trade over here, right? This is where we're swinging for the fences. We're going to get home runs. We're going to go for it. And we're going to have unlimited profit potential, right? Unlimited profit potential, super awesome. But time is going to be eating away at that option every second of every day. Market has to behave for us. And you know how much the market likes to behave for anybody? 0. It likes it 0. Whereas over here, we're saying, well, I'm okay making a little less money because this is going to be easy money to make, right? This is easy money to make. This is like, you know, taking your 2 friends and their 2 friends and their 2 friends to a network marketing meeting, right? It's easy money. You don't have to do anything for it. Okay, that's a joke. It's a huge, massive joke. But this is easy money. This is money that you can just, you can almost count on, right? We're taking a lot less risk. We're making less money. The market doesn't have to behave for us. And the market hates to behave for anybody. Time is on our side as opposed to working against us. So this is the big difference between buying options and selling options. And this is why I think that in this market right now, we need to be option sellers. We need to be trading credit spreads because we've had big recoveries. A lot of the tech stocks are back to pre-crash highs. Most of the tech stocks are back to pre-crash highs, if not beyond that. And so now is the time to say, let's go with those low risk, easy money trades, which is a credit spread. So again, to look at it over here, if I'm bearish SPY, I'm going to sell a call option about 1 strike below the current stock price. I'm going to buy a call option right at about the stock price if I'm bearish. I'm going to make $62. I'm going to risk $38. And I can turn those contracts up. I can trade 100 contracts. It's fine, whatever I want. But it's an easier trade to make money on. If I'm aggressive bearish, I'm going to maybe be over here. I'm going to be maybe buying that 284, 285 put, maybe just a little tiny bit in the money, a little bit higher than that stock price. And you know, I'm taking more risk, right? $795, but I can make a little bit more money if this, obviously, again, S&P would have to go to 0. But if this made an aggressive move down, you know, maybe from 285 to 270, I'm going to make more money buying that put option than I would be selling that call spread, that bearish call spread. But again, there's a lot of big, crazy, ugly variables in there that make the you know, statistically speaking, the odds are not on my side that this trade's going to work. And they're much more on my side that this trade's going to work. Andrew, good to see you, my friend. Is this a covered call or put? No, this is a credit spread. So a covered call would be, now there's a couple kinds of covered calls. There's synthetic covered calls, and then there's just regular traditional covered calls. But a regular covered call would be, you know, owning the stock and selling the option. If I owned shares of the SPY at you know, at 280. I bought shares at 280, and this is trading at 285. Then I might sell a 285 or a 286 call option, and you know, if it runs up above that, you know, then I have to sell my shares at whatever my strike price was where I sold that option. If it stays below, I keep that strike price premium, and I keep my shares. So that's kind of the scenario of a covered call. It's obviously a super duper quick explanation, but yes. So what I've been explaining is is credit spreads. But good question, Andrew. Yes, that's a good question. Thanks, Dan. Glad that's helpful. Yeah, I'll send you some stuff, Andrew. Send me a message. You've got my contact info. Just send me a message, and I'll get you some material. Mel, good to see you, my friend. So after an assignment, you can do a covered call. Absolutely, and that's why I love to get assigned, right? If I'm, you know, if I'm assigned some stock, then and there's a discussion that I was about to go into, and I'll save that for another time. But yes, if I'm assigned, you know, some long stock, then yeah, I'm going to sell options on that all day long, for sure. So I actually love getting assigned. There's been very few scenarios that I can think of in my head that I've not made money on assignments. But you do have to have the money to be able to hold the position open, right? And so if you know, for example, that you have, say you have $10,000 in your account, get into a trade. If you're thinking to yourself, I'm okay with assignment, I want to be assigned, then get into, you know, put on a credit spread trade that's deep in the money, that's paying you 75 cents. Remember how we talked about that? If you're making more than about 70 cents with a dollar spread, then you're running a high risk of getting assigned the stock. Get into a trade that is, you know, maybe trading at $5 or $6, and do a way deep in the money call or put spread, right? And say, I'm okay with being assigned on this. Assign away, and knowing that, you know, because that stock is maybe only $4 or $5 or $6, that your account can easily keep that position open. But if you're trading stocks that are $200 and $300 and $400, putting yourself in a risky situation of assignment is probably not in your best interest. You're not going to be able to make money on that. You're going to have to close it out with the max option loss, which is, you know, again, if you get assigned on SPY, you know, because of this kind of scenario, then, you know, your risk is, you know, $40, right? Even if you're assigned. So it's not bad. It's fine. But just a couple of things to think about. But this is a basic call spread. You know, a basic put spread would look something like this, right? If we thought the market was going to maybe, you know, maybe go up, and we thought SPY was headed higher, then I would trade a put spread. I'd sell, it's like we talked about, I'd sell that, you know, at the money, maybe slightly above on that short put, on that sell to open put. I might sell a 286 and buy a 285, something like that, and just bet on this getting up there, right? I'm going to be pretty not as good numbers, huh? Definitely not as good numbers. But yeah, that's the kind of thing I'm going to be looking at right there. So put spread, a bearish call spread versus a bullish put spread. That's kind of what we're talking about. Dan, if I'm bullish, then should I sell a put in the money and buy a put at the money? Yep, just exactly like I'm pointing out right here. Exactly. Yep, you're exactly right. So yes, indeed. Amy would like to learn how to set up covered calls after being assigned next time. So yes, it's just a matter of selling that, you know, finding that option and or finding those shares of stock and selling an option at the right place. It's a bigger discussion, and one I probably won't go into right now, but we can discuss that in some coming webinars for sure. Okay, guys, so as I mentioned, my goal was to talk a little bit about an easy, simple, clean option trading strategy for this market. And this is what I think it is. I think it's credit spreads. I think this is what we all can and should be doing on the option side of things in a scenario like this. right? In this kind of scenario, I think that's going to be our most best bet. So so that's a little bit of what we're doing there. What do you guys think? Do you have questions about that? Does that make sense? Is anybody lost? I mean, if this is your first time hearing about options, you might think to yourself, yeah, that's weird. If you've been around options a little bit, it's a great strategy. It's, you know, again, when we're trading credit spreads like this, all I'm saying is stay above or stay below, right? I'm going to save this chart right here, and I'll send it to everybody. And you guys can just have a look at that. If anybody wants to kind of review, obviously we'll have the recording as well. But you can take this chart and just kind of review that and say, okay, here's kind of what we've been talking about. Here's what we've been talking about. There's a good little way to go about it. Yeah, Amy, that's true. Credit spreads are great. Yeah, small, you can just do some small trades. You don't have to risk a ton. It's a good gig. Okay, guys, so that's what I'm going to recommend on whatever you're looking at, whatever you're trading. Somebody throw 1 or 2 stocks out before we wrap it up. Give me 1 or 2 stocks you think look interesting, and we'll talk about how we could trade a credit spread on that. 1 or 2 stocks. Somebody just throw it out there real quick. How could we trade a credit spread on some of these stocks out there? Anybody have a single idea? FNV. Andrew, let's look at FNV. Okay, these are the gold guys, right? I think the gold dudes. Lenny, okay, Eric, Tesla. Ooh, Tesla's a beauty. FNV. So what we're going to look at here is in the gold side of things. I've mentioned this before. I'm definitely bullish in that kind of area. A credit spread on something like this, the last thing that I want to do is try to ride this thing higher, right? So I've got to have, besides having a credit spread, I've got to have a good reason for entry. Now this thing has run up. I would say that the saving grace for trading this higher could potentially be some consolidation in here, right? If this consolidates for some extended period of time in this little area right here, I would trade it through the highs. If we get a little bit of that, that's great. I'm into that. I don't know if that's enough consolidation for me since this thing is run straight up to the moon here in a pretty short period of time. So I'd want to see that consolidate, kind of get a little bit of energy going on there. But again, if this starts to make a run and this starts to go for it, we can buy a put, sell a put, just keep this thing above there. That's it. So get this thing consolidating a little more, get some breakouts. If it ends up dipping back down for us a little bit, I would consider you know, getting bullish against this this little support zone down here in the high 130s, or, you know, potential move there. So maybe again, sell a put, buy a put, right? So I do it potentially on the dip, and if we get enough consolidation on the breakout. So good. Tesla's a tricky one. Tesla's so dang volatile that it's just almost pretty much all I like to do on Tesla is sell really far out of the money puts. I think that's kind of our only safe bet. Tesla makes me a little bit nervous because they're really putting up a fight about moving out of California and doing all this stuff, and everyone's getting kind of nervous about it and what's going to happen and how it's going to play out with Tesla and so on. But, you know, same kind of thing. I'll just show you real quick for anybody interested in kind of selling options. I tend to judge Tesla in the way of, can Tesla, you know, can I make $100 to $150 selling a contract? I could sell a naked Tesla put right here, just a couple of bucks, you know, $15 below current stock price, and make $3,700. But I got to stay in this in hopes that Tesla stays above $3,700, or excuse me, $790. That's pretty tough. But you can go right here. Remember, Tesla's trading $803. I'm just looking at the numbers over here. I don't sell naked options very often, except for with Tesla. Because I'm looking over here and I'm saying, okay, look at this. I can make about $160, $170, selling a $525 naked put. So as long as Tesla for 15 days doesn't drop below that area, I can get this all the way down. Maybe I take it down to 500 bucks. I can still make, you know, maybe $1.40, 140, 150 bucks selling that $500 put. And if Tesla can stay above 500 bucks for the next 15 days, I make 150 bucks per contract, right? So that's one I kind of tend to look at. Lenny, you sold a May 29 Tesla 479 put this morning. Oh, I like it. What's the 475? What'd you get for that one? What did you get filled at, by the way? That's a pretty big spread right now, but did you get about a buck? A buck-ish? Woo, 156. I like it. I like it. Nice trade. That's a great trade. That's exactly the kind of stuff I'm talking about. It's just such a good little trade. Good work. Good work on that, Lenny. That's awesome. Yeah, it's true. It was down this morning, and then, you know, after we got all that bad unemployment news, it ran up a bunch. So craziness. Hi, Esther. Hi, Esther. Let's see. Andrew, let me get back to your question here. So buy a put and sell a put, credit spread. On credit spread, we're looking for stock consolidating in a range. No, not necessarily looking for stock consolidating in a range. It's a good question, Andrew. We're just simply looking for a setup on a chart that we believe a stock can stay above or below a certain level. If we say, hey, Tesla looks really, really bearish, you know, here's this big high, here's a lower high. I think it's going to come and make another lower high before continuing down, kind of a thing. Then maybe I sell a call and buy a call in anticipation that this is going to go down and kind of do that pattern, right? So it doesn't necessarily have to be consolidation. It's just I'm saying, hey, this is a downward movement. I think Tesla's going to go down, right? And so I think they're going to be able to stay below, you know, this area or stay below that area, kind of a thing. Or I think Tesla's bullish, and I think they're going to be able to, you know, stay above that or stay above that. And I think Tesla's headed like that, right? And I would sell a put and buy a put. So, yep, it's just, it's not range specific necessarily. I like ranges so that they can kind of recharge and get things moving. It's just more of, do I think a stock can stay above or below a certain level? Such and such level, such and such. Does that make sense? So that's really the difference from buying and selling. If I'm selling an option, all I care about is that a stock stays above or below a certain level. If I'm buying an option, I need a stock to move big in the direction. If I'm buying a call, I need a stock to move up big time. If I'm buying a put, I need a stock to move down big time. Credit spreads just stay above or below the level I pick. Ray, how long do you need to stay below the value you're doing the credit spread at until expiration? It's good. That's a very good question. Very good question, Ray. So let's go back to SPY here for just a second. Real good. Oh my gosh, it keeps going over to the Zoom chat. So let's say here's our SPY here. If let's say I do a 15-day option, right? And I think, you know, SPY is down here below 280, and I sell this thing. That's a candlestick, not a hot dog or a pickle. I sell a credit spread down here. If this just goes sideways and doesn't really go anywhere, chances are I'm going to need to ride this pretty close into expiration to make some money on it. If, on the other hand, I do this and this ends up going like this, then I'm going to be able to get out at near max profit much sooner than my expiration. So if it makes an aggressive move in the direction, you know, in this bearish direction, I can get out far sooner. If my expiration is 15 days or 25 days or 45 days or whatever, if that big move happens in a 3 or 4 day period, I can get out at the end of that big move and get out with most of my profit, right? So if it moves big, I can get out sooner. If it doesn't, then I'm probably going to have to ride it till, you know, within a couple of days of expiration. Does that answer your question? And there's a big explanation behind that. I don't know if I can go into that explanation, but we're kind of at the end here, and so mean, but the big explanation doesn't change the fact that if the market moves in the direction we're looking for it to go, if we have a bearish spread and it runs down, or a bullish spread and it runs up, that just speeds up the time that we can get out of a trade. Because remember, we are selling our way in and buying our way out. So if I sell my way in and this makes a big run down, those options are losing tons of value, which is good for me as an option seller. And that's why I can get out early. If it goes sideways, then I have to count on time decay to eat away at the value, and that's a much slower process. But if it runs way down and way against me, then those options, because we're option sellers, we want the opposite thing to happen, then those options are losing tons of value, and we can take a much earlier exit. Okay, guys, I hope that was helpful. I hope that makes a little bit of sense. If it doesn't, I'm sorry, but I hope it does. And I think this is going to be a great strategy for everybody to practice, to use, to do in this kind of a stock market. Credit spreads. Credit spreads. They're beautiful. They're beautiful. Thanks, Norval. Glad it was helpful. Steve, good to see you, my friend. Thanks, Mel. Good, good. Thanks, Mary. Thank you, Amy. Glad that was helpful. Ray, good to see you on with us. And Andrew, good to see you, my friend. Okay, you guys, I'll post this recording. I'll do all that good stuff. Thanks, Jonathan. Glad to have you with us. And I'll get this up and running for everybody, and I'll get the recording posted. So thanks, guys. Have a lovely Thursday evening. Really nice to see everybody. Thanks for joining us. And again, I hope this information was helpful and useful and so on. Okay, good, Bill. All right. not Tammy Renee. Okay, I gotcha. Thanks, Bill. Yep, I'll get this recording posted and sent out. Hey, Jeff, good to see you, my friend. Thank you. Thanks, Lenny and everyone. Dan, good to see you guys. Eric, Martha. Thanks, guys. Thank you, everyone. Take care. Have a lovely evening. And more good stuff to come. More good stuff to come. Yes. Trade a credit spread tomorrow. Do a one-day credit spread. Trade it into the expiration. Go for it. You can make some money on that. Thanks, guys. Take care. Have a great night. We'll see you all soon. Bye-bye.